Good afternoon and welcome to Now You Know Fireside Chat, presented every second Saturday of the month and is sponsored by St. Rose's Alumni Association. My name is Rosalind, a St. Rose's Alumni class of 1988, and on the controls is my co-host Claire Taylor. When the session starts, you may place your questions in the chat, and if they're not answered during the presentation, we will answer them at the end. A survey will also be included in the chat. We encourage you to fill that out for us, okay? Today's topic is change your mindset today for financially secure tomorrow. As you know, a few tips to enhance our finances can be very useful. I'm elated to introduce today's speaker, who's an expert in his field. He's a financial advisor and a vice president of investments at JP Morgan Wealth Management, who manages over $100 million in client assets. With over 25 years of experience in the securities market, Mr. Pelliston has worked with multiple clients on reaching their financial objectives. He holds a BA in economics from Brooklyn College City University of New York and is a Series 7, 63, and 66 agent, registered with FINRA. He is also a community activist who sits on the board of the Life of Hope organization, which provides numerous programs for the advancement of youths, immigrants, and families. At this time, I would like to turn the mic over to the financial guru, Jean E. Pelliston.
Thank you very much. Good afternoon, everyone. Again, my name is Jean Pelliston. Some people call me Gene. Some people say Jay. So whatever is comfortable with you, no problem. So I have a little bit more than 25 years. I've got about 27 years of experience in the industry. I started my career as a stockbroker in the late 90s. I worked for several boutique firms on Wall Street for about maybe 15 years or so. And in 2008, I transitioned into being a financial advisor for one of the largest firms in the country, JP Morgan Management. I love what I do, right? I really enjoy it, and all the challenges that it comes with. Being a financial advisor, it includes a lot more than just managing client assets. It's more like finding solutions, for your clients' objectives, their goals, solving a problem, putting a puzzle together, or like a math equation. I don't know, like when you guys were in school, there might be that that math equation where you guys are working hard on, and all of a sudden everyone gets it right, and you guys are giving each other high fives. That's really what it feels like, to find a solution for that client, and they walk away, with that satisfied feeling. Only difference is obviously, we're dealing with real life issues, right? Those issues might be, how do I save for retirement? Your kid's education, buying a new home. In many cases, it could be an investment property or a vacation home if that person already has their prior home. Your parents' well-being as they age, taking care of them, or being able to manage things. There are so many scenarios that I could go through, but I think in general, it's helping clients find solutions for things that are important to them in some emotional way. And it just happens to be tied to money, as the main tool for solving that problem or arriving at, a specific solution. Now, with that being said, right, I had a few things that I wanted to touch on today. I know that our audience might have a wide range as far as age goes. So, I will try to address that in the best way possible when it comes to building wealth. Obviously, we all have different goals depending on what phase of life we're in, right? For the younger crowd, it may include buying a new car, paying college tuition, or paying rent, or just basically, staying above water, right? For the more advanced crowd, it may get a little bit more complicated. Like, how do I manage paying my mortgage and saving for my kids' college tuition? That's maybe 4 or 5 years down the road. Maybe it's not one kid, maybe it's 3 to 4 kids, depending on the family, who knows, right? Paying for your daughter's wedding, or even just managing your health plan, prescription drugs, keeping things affordable, right? Once again, many examples that we can list and go through. But a lot of the times, I think for most clients, we're plagued with these issues, and the idea of taking time to sit down and put a solid financial plan together for the future is really the last thing, that comes to mind, right? So there's that old saying that, Rome wasn't built in a day, right? So it's the same reasoning where financial security itself, it's not something that happens overnight, unless you win the Powerball or something. It's something where you have to form a plan and execute bit by bit over time, right, to finally get to that finish line. So just like anything else in life, you'll have a couple of hiccups along the way. But in general, if you're consistent and you stick with the formula, you'll find success. Now, some of you may wonder, okay, what is the formula? Obviously, I'm speaking about investment planning and putting portfolios and things like that together, depending on your objectives. Now, I think we've just had to say the least, a very eventful week. Some of us might be excited due to the recent results, or some of us may just, downright be, scared of what the future may hold. Um, Now, in either case, going back to that, having a sound financial plan to execute on is critical. January of 2025, as we enter that new year, obviously it's going to bring in a new administration, and with that, most likely will come new governing policies that will affect many lives in many different ways. All right. We don't know if what exists today, right, as far as entitlements and benefit plans, will still be around tomorrow. When I say entitlement benefit plans, education funding, Social Security, Medicare, Medicaid, other government benefits. Who knows how these things may change with the new administration that's coming about. What you can do, however, right, is try to take control of your future. And as I said before, put some form of plan together. Um, for both younger and older individuals, right, I think over the past couple of years, your biggest enemy, has been inflation. And for most people who need an explanation, inflation is the rate at which, prices for goods and services increase over, right? You go into the grocery store. I was just speaking with one of the admins on here. You go to the grocery store, and all of a sudden prices are up, by 25% or more, depending on what you're purchasing. And it's not just groceries. The price of almost every consumer product and service has increased significantly, right? If we look back in early 2022, inflation hit a peak of 9.1%. So if you're the type of person who just saves and leaves your cash sitting in that savings or checking account, you're losing a lot of purchasing power, right? Just to give a clear example, let's say, I bought this phone last year. Phone was $1. And I had another dollar that I might have, put in the bank or put under the mattress, if anything, where it was not exposed to any type of growth or anything at all. What happens? Just imagine the next year, this phone might have gone up roughly about, let's say 25%. It's $1.25 now, whereas that dollar has not grown. I haven't been able to, apply it anywhere or do anything. So you can imagine, as years and years go by, the purchasing power that you actually lose. And these things are rather, critical, right? So that's why it's important to figure out how much cash you would actually need, for a short-term obligation. And any excess cash, it needs to be invested somewhere that'll help you offset that inflation rate. Otherwise, as I said before, you're going to have some trouble funding your needs in the future. Those needs, again, could be healthcare needs, housing, or other necessities. With that being said, investments, as far as that, every individual has a different risk tolerance. Some people are conservative. Some people, a lot of times with clients, when I'm dealing with them, hey, I want to invest this money, but I don't want to expose, my myself to any type of risk. So investment planning is unique for everyone. The overall idea is, to allocate those long-term savings where it can keep up with the cost of living year to year, right? If you are, in your younger years, saving is always a good way to start. I mean, at any age, saving is important. But the saying, man cannot live by bread alone. It's the same thing with savings. You can't, you can't just save, if you have a future goal. I mean, saving alone, that'll make it pretty difficult to really sustain the lifestyle that you want in the future. So some of the things that we can do, whether young or old, participating in your employer's retirement plan, whether it be a 401k, 403b if you work for a nonprofit or a medical institution, 457 if you work for a government entity, or any retirement plan. Even if you don't plan to stay, right? You can always take your plan with you, right? Either moving it to another employer or rolling that plan over as your career progresses over the years, right? You want to try to contribute anywhere from about 10 to 15% to that plan. Um, realistically speaking, a lot of individuals will start a plan maybe because they're forced into it or it's automatically done for them when they reach that stage. And I mean, let's just be realistic. If you are contributing a minimum amount, then obviously, you're going to get a minimum result. At the end of the day, don't expect anything extravagant from that. But then also on that note, you have some individuals that may be adverse to any type of retirement plan through their employer. Okay, no problem for whatever the reason may be. You can also start your own retirement plan through your local financial institution, whether it's a bank or you go through a financial firm. So I'm speaking about setting up an IRA, whether traditional or Roth. As far as the benefits and stuff, I'll probably go into that deeper. But the idea of having a traditional IRA, especially for people that are just starting out, it kind of gives you the benefit of reducing your taxable income. So in other words, let's say I make 50,000 a year, and I decide to place 10,000 into my IRA, which excuse that number, there are IRS limits when you're doing an IRA. If you are under 50, then you're limited as of 2025 to 7,000. If you're over 50, then it's 8,000. Right. So you're limited to that. But the idea is, that traditional, if I'm putting in that 8,000, let's go back to that number, I make $50,000 a year. Then, when I go to file taxes, I'm only responsible currently for about $42,000 in income. Obviously, later on, when I reach that retirement age, I'll make distributions. I'll use that money. It will be taxable. But the idea is over that time, you've invested those assets and allowed them to grow and somehow, hopefully, stay leveled with, like we said, inflation. A Roth is a bit different, still benefits you also, but a Roth is after tax dollars. So obviously your check may be a little bit lighter. However, the benefit of the Roth is later on when I go to make those distributions at the right age, then they are they're tax free. Now, with that being said, a lot of times I get the client that will say, I just retired and I'd like to, just put everything in a Roth. Well, why do you want to do that? Well, because my friend said it. It really comes down to a unique situation. It may be for you, it may not be for you. Usually, any type of conversions that you're doing, it really depends where you are financially at that stage, how old you may be. Keep in mind when you're doing a Roth conversion, doesn't necessarily mean that you avoid the taxes because that traditional IRA that you're moving over, or that pre-tax plan that you're moving over to that Roth, you've got to pay Uncle Sam their share. You've got to pay that 10 to 20% federal, and then depending on what state that you're in, local taxes, whatever it may be. And not only that, when you roll over those funds, that Roth account, some people will say, well, now I can start making distributions right. No, you've got to have that. Number one, you've got to be over 59 and a half. And if you're making those distributions also, you've got to have that Roth plan for at least 5 years before you can start taking everything out tax free. So keep that in mind. All right. So now back to investing your excess cash that's needed in the near future, right? That is not needed in the near future. Excuse me. Some of the issues with that, even if you're taking part in those plans. I know some question me, well, okay, fine. If I do it, then what am I investing in? What makes sense for me? A lot of clients do not have that knowledge as far as how to allocate things, what to invest in. So just a key thing for some of you guys who do take part in your plan, usually what you'll notice, you may not know, hey, do I pick the S&P in it, did this and that? No, there are usually target funds, right, that do the work for you. So in other words, if I'm 45, I may look for retirement about 20, 22 years from now, my retirement age. If you were born after, I think, 1950 or 60, don't quote me on that. Your retirement age is roughly about 67%, right? So let's say I'm 25 years old and here, I'm sorry, 45 years old, and here is this target fund. It says, target fund 2045. Then that kind of gives you the idea that it's probably the plan that I should execute or take part in, because typically what happens, it's age based. The older that you get, the more that the positions within that fund, correlate themselves with your age and your retirement date. Other things now, if you are not taking part in the plan or just refuse to, asset allocation, understanding mutual funds, exchange traded funds. Typically, those are things where, try to imagine like a basket of investments, right? It's diversified. You may have sectors where here's a technology sector. Within this sector here, we've got some, Amazon or whatever the case may be. And this sector is banking. You've got your Wells Fargo, your Bank of New York. Here may be insurance companies, and this division here may be, other sectors. But the idea is it's a diversified portfolio where you're not just concentrated, into one position. Now, typically when you look at these things, the younger that you are, probably the more aggressive the plan should be, as crazy as it sounds, because the idea is you want something that provides overall growth, again, to make sure that you are keeping above that inflation. And, the younger that you are, the more conservative that you get, the more difficult things may be later to, keep up with your expenses as we get older, things like that. So, you also want to focus on new and emerging technology, AI, things of that nature. You can kind of identify these things that are going to be the wave of the future that you want to take part in early. For example, imagine maybe 30, 40 years ago, if you caught the wave of Apple early. The numbers are just extravagant. I'm not even going to mention them, but you'd be pretty happy at this point. Now, not everyone is going to want to take a look at, as we said, the market, stocks, things like that. But there are other things that you should take into consideration, whether you're aggressive, moderate, or conservative, that will help you, pretty much stay above inflation, but at the same time, probably not risk those assets that you cannot afford or not willing to take a risk with or lose. Looking into your things like your fixed annuities, variable annuities that may come with, riders. Those are usually things for, variable annuities. They are market allocated, but sometimes the insurance company will give you what they call a rider, where that client can have some type of protection, whether it be income for life, or some type of death benefit, to leave a legacy, whatever the case may be. Or you may have your fixed index annuities. The way that works is, I've got this money here. I'm giving it to the insurance company. I'm placing it in a fixed indexed annuity. So that fixed index annuity, it's going to follow an index like the S&P. So let's say the S&P 500 this year, this year has done great. I think we're somewhere around like 24% or so year to year. But let's say the S&P this year does 15%. Well, that client is not going to get 50% because they haven't participated, in the overall risk. The institution is taking that risk, so they've capped you. All right, S&P did 15%, so this year we're going to guarantee you 5, 6%, whatever the case may be. However, the benefit that you have, aside from, versus the cap, is that, let's say things are negative for the year, which obviously is a guarantee to happen. Well, that client's principal is relatively safe. They're not subjected to any loss of principal. So again, limited to the growth, but still gives you an opportunity to probably stay above inflation without taking, the excess risk that someone who is just, out there without any protection would take. Right. Other things that we want to focus on as we get older: estate planning. Estate planning and somehow, allows you to, protect those assets. again, we don't know what the future holds for any type of medical emergencies, expenses, and things of that nature. That obviously is a deeper talk, but keeping in mind it's estate planning. That definitely would be beneficial to depending on where the client stands. Insurance policies, life insurance policies, making sure that you're not leaving um, your family or children with that burden of trying to figure out how they're going to put things together. Or even if you're young, having your term policy that covers a specific term. So God forbid, I've got kids that are going to school. I've got to pay their tuition, or I've got a mortgage in my hands for the next maybe 25, 30 years. Having that term policy, God forbid, if I'm the breadwinner and something happens, then, that's kind of like, here's my insurance here where I can make sure these things are covered, and, my spouse and, my remaining family members are, not in such an uncomfortable position. Right. But all of these things, once again, are the important factors of making sure that you sit with a financial professional that can kind of go over what is needed and what direction is probably suitable for you in your unique manner. Other things for, maxing out your Social Security. A lot of us will, retire. Well, not retire, but necessarily when we reach that early age. The longer that you can delay taking your Social Security, the better the benefit. Obviously, if you don't wait for, full retirement, I mean, that Social Security could be reduced by about 33%, a third. And it might not seem like a large number, but when you start to go, when we start to go over time, 8 years, 9 years, it starts to become a significant amount that you have, you've missed out on. Also, state specific benefits for the aging. A lot of the times there are resources that you can actually use for your state, assistance in utilities, assistance in housing, assistance in medical bills. Every state is particularly different, but most of the time you will find that there are state-specific benefits, for that individual once they reach that age, whether over 60, and things like that. And I just want to touch back on the importance of, again, I keep going back to that, but finding a solution for your excess cash, because for those of us who just like to really sit and just kind of look at that savings, that statement every month, we're just concerned that, hey, it didn't go anywhere, I didn't lose anything. It's incorrect. You're exposing yourself to a lot. Again, once again, losing purchasing power over time, and the longer that you wait to take action, the the more that it hurts, because if you didn't know, for example, the Federal Reserve since September, right, they've cut interest rates by roughly about 75 basis points, right? The latest cut was this Thursday, right? They cut it by another 25 in addition to the 50 basis points in September, so a total of 75 basis points. And they are going to continue to cut as they get a better grip on inflation. I mean, they've done a great job so far. So as I said before, that 2022 peak of 9%, they've gotten it down now to about 2.44%, right? They haven't reached the goal of 2% yet, right? That's the overall, goal and outlook for inflation, but still a great job, right? And that doesn't necessarily mean that inflation goes away. It doesn't really go away. It's not like the boogeyman or something that goes and hides in the closet and pops out every 20 years to torture us. No, it's something that is persistent. So again, the importance of making sure that over those years, whether you're working or whatever you're doing, to make sure that you are, staying above that. So in general, what that means when I mentioned the Fed is lowering the rates, for some of you guys that have been, enjoying those CD rates, those money market rates, the savings rates, that you may have online, over the past 3 years, that have been pretty good. Those years are coming to an end, right? I can bet that the next time that you get a statement, it'll reflect a lower rate, from what you had, prior. I mean, those days are just about to disappear, right? It's just something that's going to happen, and you'll see, that rate decrease and just decrease over the next coming years. Once again, as the Federal Reserve kind of chops down on that and gets inflation to a hold. So, with that being said, a lot of times as I said before, clients really fear investments like, okay, maybe it's not the right time, especially with the week that we just had. The incoming administration might scare you, but you can't really pay attention to those things. You can't really time, when you want to take action. You can't time the market, and if you do, you're going to lose out a lot because just looking at the S&P alone, it's returned an average of about 10% over the past 30 years. And the S&P, for again, for people who don't know, it's the S&P 500. It's the top 500 companies, that are trading throughout the markets. So over the past 30 years, it's returned an average of 10%, right? And about 7.2% if we adjust for inflation. And over the past year, right, it's been up 24%, a little bit over that. And just this past week, 4.6. So you can kind of get the idea and where I'm getting at. Even if we look away from that, the Dow Jones itself, it's returned about an average of 11.25% over the past 30 years, over 28% year to year, and 4.6% about that this week. So the whole point that I'm making, right, and the reason I'm throwing these statistics again is to just to really point out why it's important to make sure whether you are, again, adverse to any risk, whether you kind of want to take some chances. The whole point is you want to make sure that you are taking the right steps to secure your financial future for any unexpected events, or just to make sure that you are staying above water. It's becoming even more important once again, especially in the environment that we are going to face. We don't know what we have today, if it's going to be available tomorrow. So taking action, is rather important.
We we have a couple of questions. Ross, any of those?
Yes, I do. I have the questions. So first question for Ms. Philistine is, with the risk of Social Security fund going away, should you take SS early?
I just touched on it. So the idea of Social Security funds running out early, that has been a discussion now for quite some time. Are there going to be other plans that are implemented that might stray us away from that? I don't know. But at the moment, I would tell you, taking your Social Security early is something that you want to avoid, unless you really have to. I mean, some of us fall into financial situations where we don't have a choice, but you want to avoid that because, number one, keep in mind that you are losing about a third of that Social Security. And also, if you can afford to do it, remember, when you reach retirement age or you qualify for it, depending on what year you were born, there's an 8% credit, that you get for every year that you delay. So unless there's some clear sign where, oh my God, those funds are not going to be available at all, I wouldn't take action. We don't want to panic, in certain situations. So at this moment, yes, we've heard things where these plans might not be available, this and that, but at the moment, I wouldn't panic and just pull the trigger and cut myself short. So no.
Okay. Second question, if you have a 401k retired and have not withdrawn from this plan, what age are you required to start withdrawing from this plan?
So 401k plan, 403b, whatever type of plan that you have, a lot of people might get confused because over the years, the age requirement has changed. Before COVID, we were looking at 70 and a half. Post-COVID, it was raised to 72. And as of, this year, it's 73, right? So at 73 years old, you have to, unless Congress changes it later on due to inflation again, 73 years old, you have what we call required minimum distribution, which is called RMD. So every year prior, based on December 31st, they're going to really just take a snapshot of that retirement plan, what the value is, on that day. And then that will determine, based on a life expectancy factor, what you are, what's due by December 31st of the following year. It's not something that you just want to say, hey, I'm not going to do it. You don't have a choice. That's why it's called required minimum distribution. You have to take it out. And typically, just to use simple numbers, okay, your required distribution is $1,000. Depending on your tax name, you have the choice of withholding 10 to 20% federal. That is required. And, you also have state taxes. If, you're lucky enough to live in a state like Tennessee, Florida, there are no state taxes. Don't have to worry about that. But, I'm in between New York and New Jersey. So unfortunately, state taxes are involved. So 73 in general is the age that you will have to, start taking your RMD out of your retirement plan.
Great. Next question. What advice would you give to someone regarding rolling over a 401k plan from prior employee into a IRA, traditional Roth person, currently unemployed, over 55, but intends to work for some more years?
Well, if you're no longer with that institution, you definitely want to roll over your funds and take it with you. Because one thing is, the changes, or obviously, if you were with an employer that was matching, there's no longer any match. So I definitely would advise taking that plan and rolling it over to, an institution where you get a benefit. You're able, you have much more opportunities to kind of decipher what you want to do. Just like we said before, maybe that plan that you had was allocated in securities, and you just don't want to deal with securities. You don't want to, deal with the up and downs of the market. You want to kind of see if there are other opportunities there. Rolling that plan over in the right way, of course. Like I said before, at 55, unless you have to, I wouldn't take my traditional and roll it over into a Roth. That's not the strategy. You always want to sit down and see if conversions are the right thing for you. A lot of the times they're not, unless that person happens to be in some high tax bracket, and that can't really be determined at 55. You still have years to go before you're required to do RMD, where it will have that effect depending on what the size that distribution may be. So in general, yes, taking that plan, rolling it over, and being able to sit down and design a portfolio or find a product that is suitable or that matches your your overall objectives. That's always the right direction to go. Unless that employer plan for some reason has some super benefit that you're not going to get outside of it. But usually that's really the case if you are no longer employed with that institution. Also, sometimes the first thing I would say, are you able to roll that plan over to your new employer? But I think in this case, you said you're currently unemployed, or the person is not working, they're in between jobs, or sometimes even just leaving the plan there until you get, you start that next phase of your career. And if that employer, your new employer, allows you to roll over that plan and it makes sense, they're matching, whatever the case may be. Yeah, in general, though, you want to leave the prior plan that you had if you are no longer, associated.
Got it. Thank you. Okay, can you work and still collect your pension? If so, is there a limit to what your yearly or monthly earnings would be?
Can you work and still collect your pension? Yes, you can work and still collect your pension, but depending on the age. For example, just keep in mind, that depends on the plan. I mean, there are a lot of, when we're speaking about pension plans, there are a lot of different cases. So if I work for a prior employer and there's a pension plan and I qualify for it, there shouldn't be any reason why I can't collect it at work. Now, if I am at retirement age, I'm collecting Social Security, I have this pension, and I'm working, I would really, again, sit down with a professional tax advisor, go over, what the specifics are, because in some cases, the income that you're receiving might fall over a certain threshold, and it could have the ability to reduce your Social Security payments and things of that nature. But as far as in general, taking my pension and being able to work, yeah, you should be able to do that. In examples like if you've worked for the city of New York, you were a correctional officer, whatever the case may be, they usually have a plan 20, 25 years, no matter what the age you qualify for your pension. So I've got a lot of clients that have done that. They're in their mid 40s and they are collecting their pension and working, so again, depends on the individual, what plan they have, what type of pension, what the institution rules are, things like that.
Okay. And when is the right time to borrow from your 401k or take a hardship payment?
So you're borrowing from your 401k. Again, just like we discussed with taking Social Security early, that should really be a last resort. Because now you do have the case where, okay, I borrow from my 401k. There are some cases where if it is a first time, if I'm taking money out for a first time home purchase, then I'm not subjected to the extra 10% penalty, from the, federal taxes. But last resort, because number one, you're cutting down on the potential of growth over time, because the idea of having that 401k is to grow your assets for the benefit of, that retirement age. So you're cutting into that growth. And also at the same time, you are, you are not only cutting into that, if we're speaking about a hardship loan, um, keep in mind, even though there are some cases where, for example, paying for a spouse or your primary beneficiaries medical expenses, or I think in some cases, depending on the state that you're in, eviction, emergency costs, there are hardship loans where the IRS will take into account, but taxes, you're still due for those federal taxes, state taxes, depending where you are, local taxes. Um, and in some cases, if you are under 59 and a half, again, you may be subjected to that, that 10% penalty. So you would figure maybe for every dollar that I'm taking out, I'm giving up. I could potentially be giving up 35, percent, 30 to 35%, or a little bit more, depending on where you're at. So that would be the last resort. But sometimes we have to do what we have to do. But again, last resort.
Okay. What exactly is inflation and why does it matter regarding my financial comfort?
Well, as I said, inflation is the cost of, consumer goods and products, going up every year. I mean, the reason I think the best example that I can give, if it's important, I always say this to clients. I remember I'm from Port-au-Prince, Haiti, so I came here early, at about maybe 3, 4 years old. So I can remember as early, my parents, when they moved to New York City, there was I think it was a 2 bedroom apartment. And that 2 bedroom apartment was about, roughly, like $400 or $500, a month. I think I know that because one day I saw like a receipt I had it paid. Right. Um, Now we all know $400 or $500 is not really going to get you far nowadays. I mean, you can't get anything for that. So the reason inflation is important, even not even the rent, we know the rent goes up, but keep in mind, prices that are going up all the time. Whether you're think of someone who's on fixed income, or like you said, I'm retired, I'm on fixed income, or I'm saving. Kind of think of your money on like this flat line, right? And think of cost, kind of always like a 45-degree angle or so, right? And the larger that you go out, the bigger the gap between the cost of products going on up and your cash. So the longer that you go, the bigger the gap. So let's say in New York, I had $100,000 30, 40 years ago, right? I could have chosen again. Let me go out and buy a home. I mean, back then, 30, 40 years, you probably could have bought a nice home in New York and still had some change left. Or you could have just, again, take that money, stick it under your mattress, or place it somewhere where you want it secure and it's not growing. Um, Over the years, we've seen what's happened with housing prices. All right. So imagine taking that same $100,000 that was so much 40 years ago and trying to go somewhere and do something with it now. You can't even, you probably couldn't even get a closet in New York, right? Probably, I mean, the average home in the US, you're not going to stretch far with that. So that is the importance. And not just the example of the house, but just think of expenses in general. That person is retired. They retired 40 years, 30 years, 20 years ago. Maybe they were getting a monthly income, a pension that was guaranteed at, 3, 5,000, and that was sufficient, but costs have gone up and they have not invested their money over time, whether they're conservative, whatever formula they would use, they haven't really done anything to keep it above inflation, right? Um, it, so those are the issues. I mean, you get to a certain point where once again that dollar does not stretch as much as you need it to. Expenses are always going to increase, so you want to make sure that you are keeping above water, right? And again, the more that we compound that, the bigger the issue over the years. So if if you don't want to get too complicated, I would tell you one of the things you want to focus on. Every year, just type into Google, what is the CPI, consumer pricing index? What is inflation? How much has it gone up? If it says 3%, if it says 2%, you want to make sure whatever excess cash that you have for the long term is above that. Otherwise, if it's under, you're losing. It's an issue for you. So that is why inflation is important. Hopefully, that kind of clears up the definition for you guys.
Okay. Okay. How does retiring outside of the US impact taking income from retirement sources, including Social Security?
That honestly gets complicated because we're speaking about outside government entities. So, I mean, there may be taxes that are involved in that case. That I would say is a very unique situation. I mean, versus where are you? Are you in Europe? What are their rules? So that gets complicated. I'm somewhere else and I'm taking an income payment, from another country. So there might be, who knows what the tax treaties are between that country. So there may be some liabilities on your end. So that's a little bit difficult, to really knock down and give you a specific answer as far as, I'm taking money out of my retirement account and how does it affect me if I don't know, if I'm in the UK or wherever you may be. That's a little questionable.
Got it. Thank you very much. So let's discuss with inflation and the current interest rates. Let's discuss renting a property versus buying a home.
Well, it is always a benefit to purchase a home. It's an asset that you're putting money into. Unfortunately, what's happened at this point, it's a different environment. I mean, if you can afford it, of course, it's always a great thing. But the difficulty that happens, I mean, where interest rates are, I think at this point we're looking at somewhere around 6.5%, which is way lower from the peak of 8%. I think about maybe earlier this year or something like that. So if you are able to afford it, I mean, obviously purchasing a home, building equity for yourself is always the best direction to go, as opposed to, I'm paying rent. That money is not really, you're not building equity for yourself. Especially nowadays. I mean, your rent is not going to be $200-300. I mean, if depending on the state that you live in, the city that you live in, I mean, it's thousands of dollars a month. So obviously, in any case, if you can afford that home, that is the thing that you should do. So, which brings me to another point. It's a little bit different for, younger individuals are facing a lot of challenges. Again, that dollar doesn't stretch as much as it should, and also wages, are an issue. For younger individuals, I think the average American is somewhere around like $40,000-50,000 a year. The housing prices have significantly increased. So, as opposed to early '80s and things where we were facing high rates. I mean, 77, things like that. Days of the Paul Volcker being the Fed chair. I mean, rates were double digits, but at the same time, you could have found a home for 100,000 or so. You could have maintained, that mortgage payment, making $50,000 a year. A lot of things have changed over these years. Not only that, you could have supported, a family on a single, a single on a single income. So not to stray away from the question. So if you can afford to purchase a home and build equity for yourself, that is always advised, as opposed to, excuse me, paying out rent. Depending on the person's situation. I mean, if you don't plan to, spend a long-term period wherever you may be, some people travel for certain different jobs and things of that nature. I mean, all those situations are different. But I mean, if you're in a case where, hey, this is where I live, this is where I'm going to build my long-term career and, be here for a while, then, certainly purchasing your own home and being able to build for yourself should be the direction.
Okay. And how can I tell if my investment professional is trustworthy or experienced? Kind of like what to look for when choosing a wealth and financial advisor.
Well, like we said, I think when you made the introduction, I mean, if you're a licensed financial advisor, um, FINRA, going to your FINRA website, looking up that advisor's what you call your CRD. It's kind of like a code that we have, or sometimes you can even type in that advisor's full name into FINRA. It's called broker check. And it will give you a listing of states that they are licensed in, because obviously, if that representative is dealing with you in the New York State, he has to be licensed. Looking up their record, they give you a full history. Have they had any complaints? It won't tell you their performance, whether they're great at managing money or not, but obviously being able to tell that you're dealing with someone who's reputable, looking at, some degree of their history, that'll give you an idea. Um, Same thing if you're dealing with an insurance uh, broker. Sometimes that financial advisor, like myself, we do have insurance licenses for different products that we provide. Going through your state's administration, insurance administration, you can, again, look them up, see if there's been any complaints, what the history is. You can even see, hey, this guy's managing my money. Does he have a history of bankruptcies and things like that? Obviously, if he's managing my money, but he can't manage his, that might, give you a different insight. But FINRA, and for insurance products, your state administrator. Those are things. NAIC, I think, for insurance is where you want to take a look at to make sure and look at the history that specific individual.
Okay. How to build wealth in your 30s versus if you're starting later after, like say after 50.
Um, Building wealth in your 30s. Obviously, you want to budget. Managing your finances, getting rid of debt as soon as possible. That usually is definitely a good way to start. Saving. You always want to make sure that you are yourself first, and spending less. I mean, some people wouldn't look at it, but you don't think about it, but every morning that or maybe that caramel latte from Starbucks that you really don't think is much of an expense, you start to add that up, and it gets to be a significant amount. So you really think about that. Hey, if I was taking this amount and applying it maybe towards, again, an investment portfolio, because it's something that you don't think about, right?
Right.
All right, well, I'm not worried about that. So if I were to, you would be amazed at the way that numbers just multiply, over a long period of time. So spending less and paying yourself, more definitely is one way to go. Again, we spoke about maximizing your retirement, making sure that you're contributing to your IRA, risk management, also making sure that you have an emergency fund. A lot of times it's important. I know it's kind of difficult for some people that are coming up, but trying to have an emergency fund where you can cover maybe 6 months worth of expenses. God forbid something happen, I lose my job, I'm laid off, things like that. Also, credit. Making sure that you keep your credit level. I mean, the greatest thing about the country that we live in, you can have $0, but credit will, take you a long way. So keeping your and also your utilization ratio. So in other words, I'll keep the numbers simple. If I've got, $10,000 worth of a credit, I mean, you don't want to, you don't want to have like $5,000, $6,000, 60%, of that credit, used. You want to keep that ratio low. You also don't want to, just have one credit card. You have to, most of the time, these institutions, they like to see different sorts of credit, but you're managing it. Really, it's all about the management. Keeping your credit, at a respectable level is important. So those are, some of the things I would say in your 30s. If you can apply and be disciplined, things, be pretty good.
Excellent. Thank you. And what about if someone starts a little later?
If you're starting later, I mean, the whole point is starting. At least you're starting. If you're starting later, right? Where are you when you, I mean, let's just face reality. If you're starting later based on that goal, there might be a limited time. So if you're starting later, same thing. You want to save. You will really want to sit down and let's be real and see where you are. How much can you afford to save? But the shorter the time span, the more important that it is to make sure that you're applying it somewhere where you're getting that. If I am starting later in time, then it may be very important for me to, especially if it's a retirement plan, it may be important to make sure that I am probably taking that degree, of risk to make sure that, over time I can really get, I can really get a return that makes sense and, will allow me to, sustain the lifestyle that I'm looking.
Great. Thank you very much. Oh, and if there are no other questions at this time, Claire, any other questions at this time in the chat?
I don't see any other questions in the chat, Rosalind.
Okay. Okay. Well, I would say extend my thanks to everyone for joining us. And thank you again, Mr. Philistine, for
Thank you
this
for having me.
you're welcome, for this great financial advice and segment. Please save the date and join us at our holiday Now You Know fireside chat on December 14th at 1 p.m., showcasing a famous Guyanese storyteller, Dr. Pauline Beard. Okay, and you guys enjoy the rest of your Saturday.